Okay, we've arrived pretty much at the end of the accounting cycle here. So only a couple of steps left, that's it. And then we're done. And the second to last step is going to be doing your closing entry. So again, once you've done your financial statements, the thing to keep in mind is you don't need those nominal or temporary accounts separate anymore. In other words, you don't need your revenues, expenses, and that one dividend account separate. So all of those are going to be closed. So when I say closing, again, these are not optional in a business environment, means to zero out all of those accounts. So the way that's going to work is all the revenue accounts are debited for whatever their amount is, whatever their balance is. Expense accounts and the dividends account are going to be credited for an amount equal to their balances. So we're not getting rid of them. We're just going to take whatever they are and simplify it, summarize it down into the retained earnings account. That's the purpose of what we're doing here. Now, in the case of the revenue expense accounts, we're going to use a special account there called income summary. Again, this is just a plug account with no normal balance. And as far as it temporary or real, it's extremely temporary in nature. All we're doing here, and kind of read it backwards, the purpose of income summary is to summarize income or loss for the accounting period. In other words, you want to make sure that all of the accounts that were involved in determining net income are closed. So it's sort of a check figure, right? In other words, the balance of income summary, if you've closed all the accounts correctly, should equal net income or net loss. So that's how you'll be able to identify if you've made any mistakes in that case. Now, in a modern business environment with a computer, you can usually tag an account as to, like, they'll give you like a toggle, like that says if you check that box off, this is a temporary account, so we know this is an account that's going to be closed to income summary and ultimately to retain earnings. All right, so let's look at how, so here's all the closing entries just thrown at you in just one big glom, right? So it's like, whoa, what's going on there? So we're going to go over it one at a time. So first we're going to start with closing the revenue accounts because there's usually few of them. All right, so we're going to go back to the trial balance adjustments and adjusted trial balance slide that you saw in that video, the one that's dealing with the preparation of the financial statements after adjustment. So we're just going to point out, okay, so here's the fees earned account, and you go all the way down here, and here's its balance, and it's clearly a credit balance, right? So it's a credit balance of 186.5, and of course we also had interest revenue to deal with, and that is also a credit balance of 1,500 in this case. So what you're observing here, just stop it right there, is we are debiting those two accounts for whatever their balance is, right? So whatever it is, it's equal to, we'll just debit it for that. So when you post these two lines, those two accounts will now have a zero. That's what we're achieving there. We're giving them a zero balance. Now the offsetting credit is going to be, in total, is going to go to income summary as a credit. So what we're really doing is transferring those separate credit balances as a lump sum credit balance to income summary. Now you've seen that number before. Hey, guess what? There it is. It was your total revenues on the income statement. Now we're going to go to a T account over here that has been gloriously pre-drawn by me. Boy, that looks pretty rough. It looks pretty primitive, actually. Like something you might see on a cave somewhere in France. All right, so here we go. So what happened is we just did this. We transferred that 188. Mercifully, it doesn't have any other numbers than zeros after that. I guess I could have put a K there, but for consistency's sake, I'm going to draw the zeros. So I want you to look at that first credit in income summary and interpret that as total revenues, which I will mercifully abbreviate REV. So there we go. So that's total revenues you're looking at right there. So that first number, in this case 188, equals your total revenues. Okay, now we got to close out our expense accounts. So that's what you're going to see here. And so there's all the expense accounts we have to close out. So it's the same procedure. We just look and see, well, what were their balances? Well, all the balances are given right here. And they're all what? They're all a debit balance. Right? So whatever you're looking at here, all those, that little circle there, are being closed by crediting them for whatever you see there. So that's what you're just observing there. So whatever wages expense balance was, $48,875, utilities, rent, supplies, depreciation, repairs, and insurance expense are all now going to be credited with that amount. So once that part was posted, what happened to all those expense accounts? They go to a zero now. They're a zero balance. But again, they don't cease to exist. It's just in a summary form. So now we're going to take the total of all those, and we're going to debit that to income summary. So we're transferring those separate debit balances as a total amount to income summary. So we'll go back to the T account, but before we get there, hey, guess what? You've seen that 91,250 before, because there it is. It's the total expenses that you saw in the income statement. So we got 91,250. Ooh, that got away from me a little bit. Ooh, that's eclectic. Okay, so again, I want you to interpret that as total. It'd be so nice if the software would let me actually write on the screen with my finger, because I do have a computer you can do that on, but I checked, it doesn't work here. Mouse only, that's the way it works. And it's, ooh, that's rough. So that's just total expenses, right? That's how you're looking at there. Now, the next step here is, okay, so if we take this, draw a line, which side's larger? Credit side is. So in this case, we'll end up with a balance of 96,750, which of course you would expect, because why? That's equal to your net income there. So that tells us we've closed all the accounts that we should have. All right, so we're going to do a couple more things with this T account here, and that is, how do you tell if you're looking at a net income or a net loss for the period just looking at the income summary account itself? Well, if it has a net credit balance, that would have to be an income, right? So net income here. And guess what? If it's a net debit balance, you would interpret that as a loss, which of course makes sense. That's what you're looking at. I'll try to draw those S's. Ooh, that's a little bit off the mark, but whatever. So that's how you know. But of course, the real evidence here is, well, your total revenues were obviously greater than your total expenses. So that would automatically mean, oh, well, we probably have a net income on our hands. Whereas if the reverse was true, it would totally be a net loss. So that's the other way you can look at it as well. Okay, so we're going to go back to the closing entries here. So, all right, so this is the balance we have. We'll go back to the T account, actually. So here's the balance we're stuck with in the income summary account. How do we make that a zero? Well, the answer is we're going to have to debit it for 96,750, right? So that's what we're going to do here, and that will result in a no balance. So now we have nothing in there now. So that's what you're looking at here, is the zeroing out of that very, very temporary account income summary. And of course, ultimately, what do we want to do with that? Like transfer it to retained earnings. And you've seen this step before. Here it was when we added net income there, and we came up with this subtotal, this 129,250. So that's all we're doing, is we're replicating what happened on the statement of retained earnings. We're just making it real now, because until we did the closing entries, it didn't exist really. It wasn't in the system. It was just existing on the statement of retained earnings, and of course the amount on the balance sheet for retained earnings. That's it. Otherwise, it doesn't exist. Okay, so we're almost done. We have one more closing entry because we still have to deal with what? We have a dividends balance of 30,000. So that's a debit balance. So to get rid of it, we need to credit it. So that's what you're looking at here. Credit dividends, and we don't use any go-betweens, so we want to subtract that by debiting it against the retained earnings balance. And again, you've seen that before, because that was what we did here. We said minus the dividends. So after you post that last two lines of your closing entries, you'll have $99,250 as the actual balance in retained earnings. So that's all you're doing. You're just bringing the retained earnings balance up to date, right? Because the one that's sitting there was antiquated. It was outdated because it was the old number from the previous period, because all of those temporary accounts hadn't been yet integrated into it yet. So we've done our closing entries now, and that leads us to the last thing, the end of the accounting cycle. So step 9, final step, is the post-closing trial balance. So what are we doing? We're simply making sure that debits still equal credits. Now you'll notice this one only contains balance sheet accounts. That's how you can spot that it's a post-closing trial balance. You will not see anything that would not otherwise appear on a balance sheet. So everything that we saw on our balance sheet here is going to appear there. In other words, all of these balances there are balances for trucks and accumulated depreciation. All of our payables and there are two balances right there. That's it, because those are all real accounts. And of course, the format should be, and is, oops, I just added a blank screen. There we go. Is, of course, debits, credits form. Important note, because some people get a little confused by this. When you're looking at financial statements, there are no debits and credits there. Remember, what is driving them is the basic, the formulas for them. So in other words, revenues minus expenses for the income statement, beginning retained earnings plus a net income or minus a net loss minus dividends equals any retained earnings on the statement of retained earnings. And of course, the accounting equation is the driving force behind the balance sheet. So don't think in terms of debits and credits here. It doesn't exist in that context, but it does definitely exist here. So that's what you're looking at. So whatever the normal balance rules are for your accounts, so all these accounts here have a normal balance. It's a debit, so that's why they're all in that column. Everybody else has a normal balance. It's a credit, so they all happen to appear in that column. It doesn't always stack out that neat, but it just happens to in this example. So we have total debits equal to total credits of $1,140,625, and that takes us to the end of the accounting cycle. So, and again, of course, what's going to happen on the first day, so January 1st, 2020, all the balances you're looking at here are going to be the opening day balances for MST3K, and then of course they will go back into the cycle of repeating 1, 2, 3 during the period, and so on. So it's just sort of an ongoing process. All right, that concludes the closing entries and post-closing trial balance, and also of course concludes the accounting cycle as well. So again, that's all done. So just again, for the next video that you should be entertaining at this point should be the one that deals with the wonders of doing merchandise accounting. So that'll be for the next chapter, chapter 5. So see you there.